Hello, everybody. My name is Mike Sidhu, and I'm from IBCanada Group. And I'm really excited to have a conversation today with three much more intelligent gentlemen than me. We'll just go across here. Eric Arruda is a partner with the IBCanada Group. He finds himself in Ontario today. He's elsewhere on some travels, but he's made good to make it here today to have this conversation about good debt versus bad debt. Eric and I have both been members of the IBCanada Group since its inception, formal inception back in 2021, but we've been kind of planning that whole entity since before then. And also joining us today is Darcy Henneberry and Michael Harris, both mortgage specialists, mortgage brokers from Victoria, BC. And Michael, why don't we start with you? Give us a little bit more about your background and what do you focus on?
Yeah, sure. So I've been a broker for about 9 years now. Previous to that, I was in a totally unrelated field and just wanted to make a change. I was really interested in financial services. I actually did my level 1 chartered financial analyst and decided to go into mortgages instead of investments. And yeah, so my business, I've got a small little company, and we specialize mostly with self-employed borrowers, as well as we do a lot of alternative financing, anything from private lending to things like house flippers and working on renovations, that kind of stuff.
Awesome. Yeah, see, CFA, you're much smarter than I am already. There you go.
That makes two of them. Level one.
Level one. There you go. Darcy, tell us a little bit about yourself.
Yeah, thanks for having me, Michael. It's great to be here. My name's Darcy Henneberry. I'm president of Mortgage Pal. We're a national mortgage brokerage here in Canada. And we're really focused on clients' growth. We love to get to know people that are looking to achieve, whether it's their dream of first-time home ownership or growing a portfolio, and with the purpose of generating wealth for their families and beyond. Awesome.
So maybe what I'll do is I'll get Eric and I to maybe just start the conversation here a little bit, because we've been talking about debt. And there's a lot of good debt and there's a lot of bad debt, but I don't think a lot of consumers know the difference between what is a good debt, what is a bad debt. When we think about hearing debt, certainly, I know Robert Kiyosaki talks about this all the time, is that because we don't teach money or how to create wealth in the education system, we by default have teachers from our homes, and that is typically how we get most of our financial education. And a lot of that may be okay, but to be honest, how many of our parents really were hitting out of the park in terms of financial literacy and things like that? And so we've been having this conversation with IBCanada Group about the difference between good debt and bad debt. And Eric, maybe we'll just start with kind of the following up on that discussion. And how would you define good debt and bad debt? Would love to hear your thoughts.
Yeah, on the surface, a lot of people think about debt as you borrowed to consume, and that's a bad debt. And if you borrow in the Robert Kiyosaki side of things, you borrow to buy an asset, that's a good debt. I mean, that's like service level understanding of good debt, bad debt. But I believe personally, most people are, whether you kind of like it or not, if you own a home, you are borrowing to consume, because you have the opportunity to pay off your debt. Whenever you get a paycheck, say you get, whatever it is, $2,000, you can choose to pay off your debt, or you could choose to buy more things, but you're opting not to pay off your debt, which kind of makes that purchase to consume kind of levered, like you're kind of like leveraging the purchase. Although it's not direct, people don't feel like, because they have a checking account, goes into your checking account, and then you buy your groceries, but you had the opportunity to pay off your debt. So you are kind of borrowing to buy your groceries. And if you have like a Manulife One type of product where your checking account is a line of credit, you see it more directly where, your paycheck comes in on the first and it reduces your balance by 2%, by $2,000, for example. On the 14th, reduces it again. And then you go buy your groceries. Well, you are literally borrowing to buy your groceries. So I think having a deeper understanding of good debt, bad debt goes beyond, hey, I want to borrow to buy assets, and it's bad to borrow to buy consumer goods. So I think on the service level, I think that's my understanding of it.
Yeah, and you mentioned Manulife One. Certainly, that's a product that has been to Canadians for multiple purposes. Darcy, before we were having our pre-call here, you were mentioning a little bit about the Smith maneuver and how that is beneficial and how Manulife One can be incorporated. But I'll maybe just jump over to Mike Harris here a little bit, and just, I know you're very familiar with the Manulife One product, Michael, and would love to hear your thoughts on the same question and how you view good debt versus bad debt.
So I think for me, I try and look at it as a practical point of view for my clients and customers, and we see it because we see people's finances every day. Like we see so much, we see more than their spouses see often, like as far as what they owe, what their assets are, etc. And I think it really boils down to looking at what you make and what you spend, and making sure that you're not spending more than you're making and running up debt for just maintaining your lifestyle. Whereas if you are taking on debt for a specific purpose, such as education, taking a course to upgrade to your next certificate if you're an engineer or something, or whatever it happens to be, or going into using those funds to buy an asset that's going to appreciate, I think that's kind of a very broad definition, and that's kind of my perspective. And we see it also, people think, oh, I don't want to use, using your line of credit is bad, but it actually can help your overall credit profile. That's something that you also need to think about, is using your debt regularly and paying it down really helps. From my perspective, you qualify to buy your home because you need to have a good credit score for the banks to look at.
Fantastic. Darcy, finally, just to you to circle on this, how do you find the definition, or how do you define the difference between good debt and bad debt?
Debt equals bad. Leverage equals good. That's it.
Simple.
It's that simple. Debt's bad. Leverage is good.
Yeah, nice. And I would actually love to jump off of that a little bit and just say leverage is the key to all wealth creation. When we think about a debtor, that's somebody that perpetually gets into debt or either the wrong reasons, the right reasons, whatever, but they're treating their credit like debt. And therefore it's this mindset about it, rather than thinking in the same way that we often say, don't think about your savings as cash, think your savings as capital. There's a greater responsibility or a stewardship that goes on with managing a pool of capital compared to managing a pool of savings, as an example. So, leverage, whether you're leveraging processes in a business or whether you're leveraging something to get a better rate of return somewhere else, for most people, it's a mindset shift. Do you have, staying with Darcy here for a little bit, do you have any examples of how you've been able to kind of help shift that mindset between debt and leverage?
I laugh because I actually do have an example that was on my mind as Eric was talking. It came to mind, and it's exactly what you just asked me. This young woman reached out to me. She must have been about 24 or 25 years old, and this was a few months ago now. And she said, I want to buy property, and I can't have a mortgage more than 350, 400,000. And the way she said it, it was like, I just can't do it. And I asked her, why not? What's the reason why you can't borrow more than 400,000? And she said, well, debt's bad. And you were talking about mindset, and you were talking about how really learned through our parents because of a void that's created in our education system where we're not educated on how to utilize assets, as Eric was talking about, cash, as you just mentioned, leveraging, and we've just been taught that through our parents' paradigms and our belief systems that that's bad. And in reality, there is a clear difference. And so I had that discussion with her, and we talked about how you can actually use borrowed funds, how you can borrow against an asset to generate wealth. And it was wonderful to see how over the course of a nice long, about an hour long conversation that her and I had, how her mindset shifted, and she could see how she could actually grow wealth by borrowing money and use that through a system that I love to use, which is the Smith maneuver, to convert the bad debt that she's going to be borrowing against her primary residence, convert that or debt swap that into good leveraged debt in order to leverage that and grow wealth. And I just love to see that mindset shift.
Yeah, 100%. I think that really speaks to what Eric was saying. Eric, any reflective thoughts on that mindset shift, or have you had an example of where you've helped somebody kind of reframe that mindset?
Oh yeah, I think it happens pretty much at the initial conversation with every new client. Like, you go through this educational process, you bust a few myths and show them how the viewing debt as a tool rather than chain that's going to hold you back. It will help you. It will lead you to financial independence. But one thing I would say is when we talk about debt and we talk about, okay, so I'm going to buy an asset or I'm going to invest the assets. It's really important to think about, okay, so there's the interest rate or whatever, and people don't really even know their hurdle rate of what their cost of capital is, the cost of money they have, and then where are they going to invest this money. And I think just having an understanding of what the cost of capital is to you, what's the most expensive dollar that you can borrow, and then they could look for opportunities to invest this money. So you could actually have bad debt, but they think they're doing a good thing because you could borrow at 5% and make 2%, or you're right. So that is bad debt, right? You don't want to be losing money. And then, and I know inflation has been a huge topic these days, and nominally, this calculation seems pretty simple, right? I could make 5 and I borrow 2.5 or 3, so I'm making 2. But when you have inflation and how the dollar is programmed to lose its value, and because it's a great store of value short term, but long term that's problematic. So having an understanding of what your nominal hurdle rate is, and then include inflation onto that, and say how, like, is this good debt, or should you bring it in a bit and make sure you could sleep well at night and know that you're actually getting ahead and not just buying assets, leveraging up for no reason because you're actually not getting ahead. Although holding cash is not great either, but just having a very holistic picture, and that's why we're professionals. So we could help people,
Hey, that's why you're
understand
on that
this
side of the desk, right?
because it's not a subtle thing. Like, these are deep thoughts of someone who's in the financial services realm. What is money, and and how do you use it properly, right? And these are questions that not everyone's going to be asking them, right? So
yeah,
Mike, if I can just jump in on that real quick
please.
and just say super high level, just a quick comment. The interesting thing about inflation is that the value of the debt goes down.
right. Yeah.
And I think that's a piece that most people don't realize or even discuss. We borrow $500,000. as the value of it, as our earnings go up and our dollar goes up, the balance generally goes down by principal paid on, but also the value of that 500,000 goes down too.
Yeah, the purchasing power, unfortunately, with inflation, when government inflates the monetary supply, the supply of money, and I'm going to get into CFA stuff here. I don't know, Michael's probably going to be like jumping for joy, but when you get into monetary policy, you really recognize that it's when you have an increasing amount of dollars chasing a limited supply of things, well, naturally the price of those things tends to increase and increase significantly. And I think we're seeing that over the last 2 years with the extra dollars that have been created in order to secure assets for the Bank of Canada. Those assets are therefore the sellers of those assets are able to put that money on deposit with a bank, and the bank has a fractional ability to lend out up to 9 times the value of that, and that creates stimulus, and that creates a more economic activity. But it's all done on a false pretense of the fact that the Bank of Canada has no money to buy these assets to begin with, right? But let's circle back. That's a great point, Darcy. Thanks for bringing that up. Let's circle back to Mike. And I think what seems to be bubbling up here in this conversation is the idea of mindset, and the idea of having a mindset around money, reframing the conversation sometimes, or just having a different perspective as the financial professional to bring to the table with your client. What's your reflection on helping people understand, or maybe you've got a story you might be able to share on helping people understand how to reframe their mindset around money and even leverage?
Yeah, like how I've always looked at it with my clients, and I have a couple of favorite. We all have these favorite clients that we're just, oh, it's so amazing how well they've done in real estate. That's what field we're in. But just you look at people who are like, hey, I'm really going to push it. I'm really going to see how can I buy a second house? And like a lot of people, it's very intimidating. They don't think they can. I just had this conversation with a client. They've done really well. They've chipping down on their mortgage. Their income has been going up, and they had no idea what their property is worth. We're redoing their mortgage, and we looked at it and say, hey, you've got 800 grand of equity in this. You can buy a rental. And they say, oh, that's really intimidating. And it's just kind of helping guide the client through all that and saying, hey, well, here's the steps. Here's what it's going to cost you. Here's let's look at rent. Let's look at write-offs. Let's look at all that stuff. And let's look at what that's doing for your future. So this particular client has young kids, and we're talking about, hey, they're likely not going to be able to afford to buy. Like if we look at the market in our major cities, it's really tough to buy a property. And so this client, we're looking at, hey, you can generate some wealth. You're even if you're just breaking even cash flow wise, you're not making money. Hey, here's an asset that you can pass on along to your daughter, because he admitted, he's like, I don't want her living here when she's 30, and she's 16, and it's in that shape where like this guy can visualize, okay, she's going to go to university, probably she's doing well in school, or maybe she doesn't go to university, but she's going to have a job, and how am I going to get her out of the house, and at the same time create an asset for myself? And so we ran all the numbers, and he bought a condo, and it's bought it relatively close to a university he thinks she might go to, and he made sure the numbers work. But there's having real estate gives you something tangible, and I think a lot of people can wrap their head around that and appreciate it. So I think it's really just changing that mindset of being like, hey, being a landlord is tough. The tenants are bad. They're, what happens if the market goes down? What happens if it's empty? I'm not going to be able to afford it. Oh, it's scary. There's all these costs. Like it's too much work. Like a lot of people think it's too much work. And I think, owning rental properties myself, it is often not fun. But if you look at, going to work, that's not always fun for everybody either. So, you think about like, how are you going to build wealth for yourself? It's, I think, using leverage, as Darcy said, not debt per se, can be a great way to build something for yourself and for your future, whether that's your kids or a charitable organization, or whatever your future entails.
That's a great point. Life is hard, so choose your heart.
Exactly.
If you were, for example, smoking, and going through and recognizing that the likelihood of your increased risk of having cancer may be higher, that's hard. Quitting may be hard too, right? Being healthy or choosing to continue to have, I know Darcy, you and I were talking about this a couple of weeks ago, where we're like, man, I got to get off these carbs. And
The salad. Choose the salad.
Oh, the salad's so hard.
Salad is hard. Oh, but you know what?
So I love what we're discussing here. If I can jump in, because
Yeah,
we're still
please.
talking about mindset, right? Like that's what you're talking about is decision making, and decision making is what successful people thrive at. Like, that is the key component. And I think we're talking about success too, because we're discussing, the difference between debt and growth. And it was Albert E.N. Gary who wrote The Common Denominator of Success, and he distilled what the difference is between successful people and failures. And I think it's exactly what both Michaels were just discussing there. He said that successful people are influenced by the desire for pleasing results. So it's the desire for pleasing results that successful people are really attracted to, while failures, if we can use that word in contrast to successful people, are influenced by the desire for pleasing methods and are willing to accept the results that are driven by those methods. Absolutely. And so it's like, the pleasing methods, that's what I like to call not just me, but that's the comfort zone. And it's really, it's our purpose. If we have goals and if we have a purpose for our life, that pulls us toward success, because by having tangible goals like what Michael was just discussing, and a vision for the future, you can that will pull you forward through, and it will force you to do things that you don't want to do. Successful people do things they don't want to do. That's
your heart.
it.
Choose your heart.
Choose your heart.
Yeah. And I think that's a really powerful statement that both of you and Eric as well have been making is, number one, we are financial professionals. Therefore, our number one goal, and I love the book, The Go-Giver, that says the law of influence says that you become influential as you make somebody else's priorities your agenda, essentially. Paraphrasing there, but we have to understand, we have to do the hard work, understand technically what it takes to promote success for our clients. We also have to take what those clients' biases, understandings, all those things are, and kind of merge the two. And if we don't understand what the goal is, to Michael, to your point, you might have small children and stuff, and you're like, oh my gosh, how do I be a landlord and all that sort of stuff? Well, to act out of ignorance is to have ignorance about your results. You're never going to be able to quantify what you want concretely, because success, to your point, Darcy, is not about luck. It's all about, number one, removing ignorance out of the picture. You've got to go get the information. You've got to make your due diligent decision. However, once you've made a due diligent decision, now how do we stick to that decision? By getting the right information, confirming where your direction is, and whether it's Smith maneuver or rental properties, or even for us, Eric and I have got a bias towards the infinite banking concept, because we really believe it's a cash flow tool, it's a tax planning tool, it's a leveraging tool, it's a retirement tool, it's a tool. Tools are there for you to be able to construct a better thing. And you're never going to build a house without a level and a hammer and some nails and tools. You're never going to be pulling anybody's teeth out. Well, maybe a back alley deal where you forgot to pay Guido his money. But when you
we won't talk about Michael's experience last week.
Where you go to a dentist, and if they don't have the Novocaine and the assistants and the lighting and all that, it is a tool in order for them to have help people have better teeth, right? Everything is a tool. So from our profession, whether it's understanding leverage, understanding opportunity costs, like if I make this decision today, especially to your point, Darcy, about it being in an inflationary environment right now. If I and Eric, I know you're talking about, if you leave your cash idle, what's going to happen to the opportunity cost as that purchasing power erodes down? Well, maybe I should be thinking about some sort of tangible asset. Right now I'm reading a book by under the pseudonym Genzo Parsons. It was written in 1974 called The Dying of Money. It's a very wonderful expose on inflation, and it gives you examples of some of the different, the Weimar Republic, or it's really about the 20th century, written before Zimbabwe and Argentina and all these real big problems in the monetary system. But it's a really great thing to say, yeah, we love inflation because it creates wealth, but does it really create wealth, or does it preserve the purchasing power of that wealth? Because certainly we're not going to get more wealthy in an inflation where inflation hits different assets at different times, but generally speaking, money depreciates equally among all currencies. How do we preserve that buying power? Right? We have to put our money to work in an environment that preserves the purchasing power of our dollar, whether that's tangible through real estate or through gold and silver, or which is real money, or through the use of a properly designed tax-exempt life insurance contract in the way that Nelson Nash teaches infinite banking. We've got to think about ways that just not put our money in the bank or under our mattress, because by the time, if we just say we were going to bury it in our backyard, well, if I had $1 million 10 years ago, I might be able to buy 2 houses in Victoria, but now I can only buy 1 if I'm using the cash to straight up do that. So we have to recognize that cash is a moving target, where tangible assets are less so moving and more of a preservation tool. So using your money in order to realize that if the opportunity cost or the decision for me to move my cash into something that generates or preserves my purchasing power is a better decision, because of the opportunity I'm giving up is the opportunity to lose in an inflationary environment. But again, it all comes back to goals. If somebody I'm talking to, well, I'll give you an example. A family friend had a vehicle for sale, and they were selling it for really, really cheap. And the person who bought it said, well, I need to give you the fair market price. And she said, well, the last thing I need is another bunch of money. I've already got enough, and I'm 94 years old, and I'm not going to be around forever. And what am I going to do with an extra $5,000 or $6,000? Right? It's all about the goals. And for somebody, I'll generally say, loosely say, I know Eric is probably considerably younger than all the rest of us. Somebody said busting myths, and I was thinking about bust a move from my school days. But somebody Eric's age would say, well, I actually need that $4,000 or $5,000 extra dollars to sell that vehicle, because it's going to be more meaningful long term. So I'd like to open this up to maybe just have some other commentary or reflections on some of the things that maybe I've just mentioned or talked about, or some of the things that we've talked about during this call.
Yeah, I think definitely it just, what people are doing with this inflationary environment is they're trying to short the dollar. They want to get out of the dollar and monetize other things like real estate, because like I said earlier, yes, it's a short-term store of value, but long-term, dollar's not helping you, and you need to get out of it. And they monetize real estate, gold, etc. And people don't want dollars for the sake of dollars. They don't want more zeros. They want what money can buy, not the dollars themselves. If you wanted more zeros, then you could just go to a country that has, hyperinflation and see where that got them. And you could have many zeros in your bank account, but it doesn't buy you anything. So the important part is, we're talking about goals, is, that client of yours who had the daughter, they want a house, get her out of the house, and it helps the father as well. He doesn't want the money. He wants the security for his daughter, and those are tangible goals that he wants. It's not people don't want zeros in their bank account. They want real things.
Yeah.
This is why I think, the best time to start doing this stuff is today, because real estate in general over time has appreciated. And, if you're in a position where, hey, you can buy that extra property that you're going to rent out and it can cover itself. And hey, maybe one day that's your retirement home. Maybe one day that's the place that your mom or dad needs to move into. There's lots of uses for it besides just, putting it, and I know this is like, not trying to throw stocks under the bus or anything, but you can put all your money in stocks, but it isn't something tangible. And I think a lot of people can relate to something a little bit more tangible. And I think this is what we try to do with all our clients is, hey, have you got a financial planner? Have you got an accountant? Like, I'm a mortgage broker, but I'm not just here to like sell you a mortgage. We're here to help you kind of plan for your future. And and that's when you look at if you're a broker and you're doing your job correctly, you're looking at, hey, what are you looking to do in the future? Because that might be a different product than just giving you the cheapest rate or the whatever the least flexible product. Because hey, you're going to want a line of credit, or hey, you might be able to buy a property in the future. What does that look like? Oh, well, let's talk about planning for that. So I think that's why, just as a consumer, you really want to have people you trust and have a good accountant, financial planner, insurance person, mortgage broker in your life, so that you can kind of map out those goals with them and see what's achievable. And for some people, they do have this bad debt that we've talked about, and that's getting out of that is part of the process. So I think that one kind of thing that we sometimes ignore in these conversations is that there are people out there who, yeah, they own a house, but they also have 60 grand in credit card debt, or they have, and it's looking at how can we restructure everything for that. And that's the other thing, like, good debt, bad debt. Well, using some of that leverage to get yourself out of that bad debt and get your life back together can be a good thing to look at as well.
Yeah. What comes to my mind is a little bit, just to go back to, you mentioned ignorance a couple of times, and I want to acknowledge the viewer here, because ignorance, the opposite of ignorance is awareness. And being here and getting yourself educated, you're becoming aware, more aware than when you started this call. So opposite of ignorance is awareness. And we talked about mindset. What's mindset? Mindset is attitude. So what is your attitude toward money? We talked about paradigms briefly. Paradigms, a belief system, multitude of habits that drive our beliefs, drive our desires. Our desires move our body, and our movements cause our actions and our results. So what is your belief system around money? And I just caution everybody on here to be careful with what that you know.
As Will Rogers would say, it's not what we know to be true, it's what we think that's true that just isn't, that gets us into trouble. And I know I totally butchered that quote, but like, I am no Will Rogers, the cowboy wisdom of Will Rogers. Well, gentlemen, look, let's put a wrap on this. Just, I think, having an understanding that number one, the illusion of ignorance. I think we've hammered ignorance to death, but there is an illusion of ignorance, and sometimes what you don't know can be very harmful. It's best to always consult with, as all three of these gentlemen have described, consult with professionals, making sure that you're getting a relationship with somebody that you know, like, and trust, because people do business with who they know, like, and trust. And the more transparent that you can be with your financial planner or your mortgage broker, whoever you're dealing with, the more they can give you the right advice, because it would be a real shame. Michael, you pointed this out, and I know you and I have talked about this before, about how different people, even in a couple's relationship, might be not telling the whole truth about their financial situation to their partner. How dangerous is that? From a perspective of number one, the shame and guilt that goes along and associates itself with the burden of bad debt. But number two, if you don't disclose what's proper to disclose for your person helping you do your plan, that could spell bad news, right? That could spell bad news, because if you thought, oh, well, I'm going along this trajectory, and you're having a transparent agreement on the table, but you're hiding something that maybe should be brought forth, and they're giving you advice based on what you're disclosing. If there's a lack of disclosure, you might be getting the wrong advice. So I think it comes back to know, like, and trust. And then finally, understanding the power of good debt and how you cannot lose your opportunity costs of either bad debt, bad choices, but also the decision between good and better is often the difficult one, not the one that's between good and bad. The good and bad one is very black and white, it's very clear. But when you're making a decision between good and better, now you have to have a facilitated conversation with somebody that can lead you through that. And having an infinite banking contract as a central focal point in your financial plan may allow you to give rise to other opportunities, to do different things. I know Michael gives me a hard time because I'm always harping on tax. But to have a tax efficient strategy is always better than to have a non-efficient strategy from a tax perspective. So let's leave it at that, gentlemen. Thank you again, Darcy, Eric, Michael, especially our two guests, Darcy and Michael, for coming on. And Eric, we will be seeing you real soon. And for more information, Darcy, where can people find you?
My phone number is 604-992-7323. It's my direct cell phone. You give me a call, I'll be happy to help you.
And Michael, where can people reach you?
If you just look up mortgagefit.ca, we've got all our contact there, email, texting, phone numbers, all that stuff.
Awesome. And to find either Eric or myself, just look under the Find a Practitioner under Infinite Banking Canada, or IBCanada Group.ca. That's IBCanada Group.ca. Thanks again, and we'll see you next time.
IBCanada Group, your independent authority for information on the infinite banking concept.